So the Federal Reserve has just released their announcement. They're going to hold rates steady at 3.5 to 3.75%. This is January 28th, as of 2:30 Eastern Time. Their reasoning is that inflation, according to them, is not moved much. Job market hasn't moved much. So they're saying they want to keep it steady. So, yeah, let's take a look. Fed meeting, central bank holds rates. Powell faces pressure from Trump. The central bank announced it would hold its benchmark interest rate steady. The meeting follows weeks of political pressure from the Trump administration and a recently announced Department of Justice probe. This is from Business Insider. Some of the justifications is, the job market, inflation rates, housing markets. According to them, all of those are flat, so they're going to keep the rates flat. There were 2 dissenting votes. So let's hear from Powell.
It might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really 2 questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data.
So you can see he's reading off his notes there. I'm not sure how much of this is his decision. He is the chair, but, a lot of these decisions get made by other people. The likely justification, that growth is still solid, expanding at a solid pace. The labor market isn't cracking further. They're noting that the job gains have remained low. Inflation is still above their 2% target, although there was a recent report saying inflation was down to 1%, but, according to the Fed, it's still above 2%. He's saying uncertainty is still elevated, so this is sort of a risk management approach, according to the Fed. There were, like I said before, there were 2 dissents that wanted to cut it by 25 basis points. But the majority said, let's just hold it. But yeah, so the 3 main things they're looking at is the labor market, inflation, and financial and international, developments. Let's take a listen.
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave it all under the circumstances?
Again, I don't want to get into this. It's not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So, I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role.
So apparently, his explanation is we don't talk about the dollar. We don't care about the dollar price. But it makes no sense if you're talking about inflation, right? If you're targeting inflation numbers, by default you're talking about the dollar. So there's a lot of very weird activity going on with the Fed.
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows.
So, I'll leave it there. He's saying that his policy is not restrictive. He doesn't want it to be too, but here's the thing. When the Fed lowers rates, that's sometimes a good thing, sometimes a bad thing. It depends on how you look at it, right? It's a good thing in that it could stimulate the economy. It could lead to more job growth. It's a bad thing in that it could lead to more inflation, which could lead to a currency crisis. So leaving it where it is considered the conservative approach. So we'll see how things play out, but that's my update on the Fed rate decision.